The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks, and I'm going to start today with the bond chart going back last week. If you recall, there was a spike in the bonds that went all the way up to 135 that happened on the 23rd of December. That was a fat-fingered error, folks. What that means is somebody had their finger on the wrong key and they'd sold 10,000 contracts of bonds on the way up. What happened? The Chicago Mercantile Exchange disallowed all of those trades. I know that's not fair, but that's what they did. If you make an error like that, they're going to tag you and they're going to tag me, but whoever did it got away with it, and that is not a fair playing field. So just keep that in mind. It just happens. We had the same thing happen today in the gold market. I'm going to show you that one next. This was done on such small volume that it was just really quite unbelievable. I'll just bring it up here in just a second here. You'll see gold went from 1147 all the way down to 1247 down to 1212 in a matter of just a few minutes, about 3 minutes, and went right back up again. That was done on a total volume of around 11,000 contracts as a maximum. I did the time and trades with Jim Twentyman, who is an expert with data, and just to double check everything. The largest number of contracts that traded hands on either up or down side on that was 60. Now, can you imagine? That's just unfathomable to me. A market as big as gold, that something like that could happen. That's a very scary situation, in my opinion. So just keep in mind, folks, you've got to be able to keep yourself protected here, because it could really be something that is really very, very dangerous. And on top of that, we have to worry about cyber terrorism, which is also something that is a little scary. But when I saw that happen in the gold, it bothered me. I'll tell you a story on when I was in the Chicago Mercantile Exchange. It was I believe it was the early part of '83. We were trading. I was never in the Jennie Mae pit. The Jennie Maes were the government mortgage things that they had that traded alongside with the Treasury bonds, but the bonds were traded at the Board of Trade. So the Jennie Mae was the contract that they used, and it was a big pit. There was always 100 or more traders in there. And one of the Merrill Lynch brokers put an order in to buy 5,000 contracts of the Jennie Maes, and when he to buy them at the market, which is a stupid order. It came out of Asia. Somebody wanted to buy it, and the market just ran like crazy. It ran like $2,500, 2.5 Jennie Mae points, equivalent to 2.5 bond points, and then they realized that the guy from Asia put a sell order in. So what they had to do is they had to reverse the buy and then double up the sell. So instead of selling 5, instead of getting out of 5, they had to sell 10. They had to get out of their 5 they were originally in, and then the other 5 that they went in. And that was a big thing that went on at the Merc. What happened during that time? The floor broker that had it was really hurt really bad. So anyway, that's what we'll see. What happens with these, but you've got to be careful. No matter what, even if you had a stop in there and you got hit, it's better to take that than to get into a situation where you come in and it doesn't work. In 1987, this is the kind of market that we were in during the crash of '87. Believe me, we don't want to go through that again. But this is not that type of the market, because that market was trading, but the bid and offers were so far apart that nobody wanted to trade. That was the bad part. The S&P was trading at around 300, and the bid was 305. The offer was 315. So you can imagine what it would be today if something like that were to happen. It might happen. Maybe it will. Maybe it won't. But some of the things that are there, give me a little bit of trepidation. I'm just warning you of the possibility of some of these things that could be happening. I also wanted to mention to the fact that I heard on the news today. First thing I do when I get up in the morning is I check to see that the end of the world has not happened, and see if no one's been taken out of office, or anything major to make the markets move. And it was rather quiet, but there was a gentleman on, and they were going over the fines that J.P. Morgan has paid over the past year, and they amounted to $19 billion. That's a B with a B, B-I-L-L-I-O-N. I couldn't believe that, and they still have the same CEO. To me, that I just don't understand how they could be fined that much. The latest one was $2 billion for the people that they put in the Bernie Madoff funds without due diligence. So anyway, let's get on to the markets. The first market that I want to cover today is going to be close to home to most of you folks that are in the Midwest, because I think we need to talk about what is happening, to the crude oil market, folks, because we've had some really, really bad weather across the. In fact, it's everywhere, all across the U.S., and the market has not responded with a bullish response. And we know that if markets don't respond to a bullish response, they usually go the other way. And we went down to the 786 on Friday, down to 93.99 in the crude oil. And with all the cold weather that came through the Midwest, and more to come, more Arctic air coming, the market is not able to rally. That's a sign that there's an oversupply of crude oil and heating oil out there somewhere, folks. So I wouldn't get too acclimated to the bullish side of this market as of yet, because it certainly doesn't look very bullish from a technical standpoint. And when the fact is, when they're not, putting the prices up with bad weather, that's a pretty bad sign, because it's not following along with what the fundamentals are telling you. Not that the fundamentals mean very much, but when they don't go the way they should be going, they only have one other way to go, and that is to the downside. So what we need to do now is to take a look at the we're going to take a look at the Dow Jones Industrial Average here, because we always start the show with the give me a second here to get it put up, and then we'll be ready. And then we will we still have this gap down here that we're going to fill, which is down around the 1360. So we're still about 60 points away from that gap, and believe me, that will be filled. We've had very few gaps in the Dow Jones over the years, and that's one that I am almost positive will be filled, and that comes in around the 16,350 level. And so we'll have to take a look at that as we go through day by day. Now, we topped on the new moon and the Bradley date on the 31st of December, and the next full moon will be coming in around the 13th of January, 13th or 14th of January. So we'll want to be watching. That'll be a week from today, so we'll be able to keep an eye on that day. That should be at least a temporary low in this sell-off that we're having in the markets. The major patterns that we've looked at through here have already been completed. All we're doing now is to see what the first sell-off is going to be, and from that level we'll be we'll move on to the next thing. I'll cover gold after we get through the break. I wanted to go through some of the stock market things that we're looking at through here, because we've had a pretty good reversal today in the market. The Dow Jones opened up about 70 points and took out the previous day's high from January the 3rd. But the problem is that the S&P 500 could not do that, and the Nasdaq, all the time the Dow was rallying and the S&P was rallying, the Nasdaq was making new lows, and that's a sign of really bad weakness, because the Nasdaq has been the leader, all along, and that's something that I think is relatively important. I posted into my newsletter this year an interesting pattern that we have in Google, So far, it hasn't happened, but it still could be set up. And I think, if this market's gone up forever, but we will take a look at it here. I wanted to show you the pattern that we have here in Google. First, what I'll do is I'll show the weekly chart, and you can see, what we've done with the weekly chart. And if you'll notice, when you take a look at this, you'll see a small circle inside the larger circle. Well, that means that there's an island reversal pattern potentially up there. In other words, if Google closes around between 11:05 and 11:09 and then gaps below 11:04 tomorrow or the next day, it means it's going to leave an island up there. And that's what happened to Apple when it was up at 7:03. If you recall, it was making that big butterfly pattern in Apple at 7:03. So now we have Google doing the same type of a situation where we've had this big run up, and there's a huge gap in Google between 873 and 973. I'll put the daily up here so you can see it a little bit better, because there's an interesting pattern here that we should look at, and that is on the same day. Just give me 1 second here. Oh dear, it's going to be a little more difficult than I thought. Now I'll be able to do it. 1 second. The Italian's got his game on almost. Okay, I'm going to show you 2 years of Google here, because the reason why it's so interesting, the last time it did this pattern, it dropped 20%. That was back in 2012. If you'll look at these, January the 6th of 2012, we left the same type of island pattern down when it was trading at around 689, and from there we dropped all the way to 541. Now we're trading up at $1,110 a share with the same type of pattern. What that means, folks, is that everybody that's been buying Google over the past 2 weeks is underwater. It's still up from where it was 2 weeks ago, but everybody that's bought it in the last 2 weeks, those folks aren't doing very well. So if it gaps down, that leaves an island reversal pattern, which is one of the most bearish patterns that we have in all of pattern recognition. It is really a very, very negative pattern if this happens in Google. We'll be watching that on Wednesday, of course, and again on Thursday. We've had some very bearish news coming across the grain markets, but the grain markets have rallied. That's mainly telling us that they've been oversold anyway, so there's nothing to do there. We'll cover that on Thursday's program. So those are the things that we're keeping an eye on right now. But the market is still under a little pressure. We got the Dow down about 36 points, the S&P down 5, and the Nasdaq down 19.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. With over 3 decades of trading experience, Andy Hecht brings a tremendous amount of knowledge and expertise to each weekly issue of his newsletter, the Technomental Commodity Report. The Technomental Commodity Report gives you Andy's unique technomental analysis of the commodities market, a combination of technicals and fundamental analysis which he has developed and perfected over his many years of trading. The Technomental Commodity Report is only $49 a month, and right now you can get a full month-long trial subscription while paying absolutely nothing. See for yourself the kind of weekly report Andy delivers to his subscribers every Thursday morning. You'll receive specific stock, ETF, and option trades based on Andy's analysis, so no futures account is required. For all the details and to start your month-long free trial to the Technomental Commodity Report, visit TFNN.com today.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks. So we've got the Dow down 30, NASDAQ down about 18, S&P down 5. Basically, what I've done is I posted the chart as a request. Someone asked to look at that Apple high that we had way back in September of last year when it was 703. And as you can see, it left that big gap down the following day. And there's potential for Google to do that if it gaps below the 104 level sometime this week. In other words, it can't close that gap and go down. It wouldn't be the same pattern. But if it leaves that island, that really means a great deal. That's a that trade works probably better than 90% of the time. It's very rare, but if it does, it really makes a tremendous move, and it would at least be a 20% correction, which would be $200 down in Google. Also on the Apple chart, you'll see that it's made an ABCD pattern. It did not make the 61% retracement. It missed that by $8, but it did make a perfect AB equals CD pattern. And now we are making another pattern on the downside, ABCD, from a bullish standpoint. We got a call from Lou in New Nashua. Are you there, Lou?
That's right. Yes, I am, and we're freezing up here.
Yeah, I can see it from the Boston weather reports. What can I do for you, my friend? By the way, if we get stuck into the break, please hang on, okay?
Okay. Natural gas, March mini contract.
I don't do the mini, but I can put up I can certainly put up the natural gas contract if you'll give me just a second.
Sure.
I don't look at that very often. I hardly ever. Well, I trade it maybe once a year, and when I see everything working right, but I can get the chart up. it's actually holding up really well considering what's happening to crude oil and all the other things that are going on. So it's made some type of a double top up in here at that 415 or 450 level. But I believe that if you get it down to 390, I think you'd have to take a look at it from the long side.
Mm-hmm. So I think we're dealing with 4290, something like that.
Yes, that's correct. Now you've made a nice little head and shoulders pattern that completed 2 days ago up around the 4.40 level, and as long as you don't take that out, I think you could get down to that 390 level pretty easily, and that would be a place to take a look at it, possibly from the long side. Let's take a look at this on a weekly basis just to be safe. Well, this thing used to be really expensive, didn't it? Holy cow. I hadn't realized that it got to 14 at one time. My goodness, that's a heck of a move from 14 down to 2. That's almost like what the NASDAQ did in 2000. Yeah, we could easily come down to 390 in this one. This is, I wouldn't get excited about this till I saw the 390 level from the long side.
Oh, geez, wow. Okay.
Yeah.
Well, hang on there then.
Yeah, well, the thing is, the weather, it should be supportive to natural gas too, and it's down a little bit, but compared to what, crude oil is down a little, and and heating oil, everything is not acting well, given the fact that we've had this terrible weather. And usually when you have bad weather like this, supplies dry up, and people do forward buying, and this is not happening, and that's a negative sign.
Okay, I can see that. Well, appreciate that.
Okay, my friend, listen, and Happy New Year to you, and I hope you thaw out before the 4th of July.
Thank you.
Okay, my friend. All right. I empathize with everybody that's out there in the cold weather, because it's not going to get any hotter than 71 here in Tucson today. The sun is out and it's nice and bright, but it's going to be a little chilly at 71. Our normal temperature is around 76 this time of the year. Of course, you can laugh at us during the summer when it's 116, but that doesn't happen very often. We've had a request to take a look at the euro yen, and what I'm going to do is I'm going to post the euro yen and show you that it's had one heck of a move from November. We've been watching that through the Japanese yen itself. But the one that I wanted to bring up and to show you is the dollar versus the yen, because that one is the one that has really got a terrific correlation with the Nikkei Dow. It's a better than 90% correlation with the Nikkei Dow. And if you'll give me a second here, I'll be able to get the daily up, and we'll take a look at this. And you'll see that we've completed some... we got to take a break here. I'll be back. Oh, dear. Missed that one.
2014 has arrived, and Tom O'Brien has put together a special webinar for subscribers to his daily newsletter, Market Insights. That will be taking place the evening of Tuesday, January 7th from 6:30 till 7:30 p.m. All you have to do to attend this live event, which will be archived, is to be a subscriber to Tom's daily trading newsletter on the day of the webinar. Tom will be breaking down the 3 most important sectors that will shape the markets in 2014, the S&P, bonds, and real estate. Tom will provide his subscribers with a technical and fundamental take on these 3 sectors and how they can shape the entire market outlook for the upcoming year. For a limited time, we're extending a free trial to Tom's daily newsletter to a full 30 days. And even if you had the free trial previously, you're welcome to sign up and take advantage of this special offer, only good till January the 7th. Don't let another year pass you by. Sign up for your 30-day trial to Market Insights today and gain access to this exciting live webinar with Tom O'Brien. Visit the front page of TFNN.com today.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, folks, I posted into Tiger TV the U.S. dollar versus the Japanese yen. As you can see on the long-term weekly basis, we've hit a perfect 61% retracement 2 weeks ago, and that's the same time that we made a little above 16,000 in the Nikkei. And what I'd like for you to take a look at now is I'm going to post the Nikkei Dow overlaid on the U.S. dollar index chart, and you'll see that the correlation here is better than 90%. It's really amazing, and that's telling us that we're probably going to have a pretty severe correction in the Nikkei Dow. It was down about 3% overnight on a Monday, and we've started down here in the United States a little bit this week, but it's still quite early. There's nobody that is even remotely concerned about whether the market is going to go make new highs. They all seem to think that it will, and it certainly could. It's still in a very bullish mode without anybody's argument at all, but that could change if we get a sharp market of one time down quite a bit. I will say this without any hesitation at all: sometime in the next few months we're going to see a down day in the stock market that will be at least 500 points. Now that's easy to figure out, folks, because on the way up we had two 300-point moves to the upside, And so we'll make a 1.618 expansion to the downside because fear is a greater emotion than greed. So you will see the Dow down about 500 points, which is no big deal. It's just about 3.5–4%. So they'll take it as a buying opportunity, which it certainly could be. But this is something that we want to be watching when it does occur. So this is the factors that we're looking at as we're looking at this. I really believe that the Bradley model has kicked in right here. We have all those patterns that we talked about for the past month or so have all come together. We made a double top in the New York Stock Exchange Index by 20 cents over the high in 2007. I couldn't believe it could only go above it by 2007. It's trading at 10,381 and it went to 10,402. So it was just really amazing of what happened. We are going to have tremendous swings, folks. I believe 2014 is going to be the year of volatility, and I think it's going to be something that it's going to probably rewrite the record books in some areas. That would be my guess. This weekend over Bloomberg, they had the top 14 analysts last year, the predictions of the top 14 analysts, and all 14 of the analysts this year were very, very bullish with a minimum expectation of 2,100 in the S&P. So 14 out of 14 is pretty good. That reminds me of September of 2013, 2012. It was 2013. Yeah, 2012. I'm sorry. When Apple was at 700. You'll remember that there were 34 analysts on Wall Street that covered Apple, and all 34 were bullish with price objectives ranging from 800 to 1250 on Apple. And from there, it went down to 375. It doesn't mean that it's not a great company, which it certainly is. It just means that these things get blown out of proportion and they turn around and go the opposite way. If you don't believe in technical analysis, go on the internet and search out Andrew Lowe from MIT, and you'll see some of the wonderful articles that he's written about why technical analysis works and has stood the test of time for thousands of years. So it's something to keep in mind. I don't look at the fundamentals. I try to just see what the charts are doing and then, let the news follow behind it, but we'll have to wait and see. Today's a perfect example in crude oil. I mean, why cannot crude oil rally with sub-zero temperatures all across the United States? Anything, I think yesterday at Rich Anderson's house up in Minneapolis, up in Eden Prairie, it was 20 below. And the game last night with the Packers and the 49ers, I think it was 6 below. So these are very cold temperatures. It should cause heating oil and crude oil to rise. That means that there's more supplies out there. That's all it means. That there's people are not afraid of buying crude oil at a cheaper price, so they're not stocking up. That's the bottom line of what we're watching at that point. I covered the jab that we had down in gold, but I haven't gotten back to. I want to cover gold because I am beginning to. We're very, very close to something really significant. It hasn't turned the main corner yet. If you give me a second here, I want to put up the daily chart here on gold because it's very informative in my opinion, and my opinion counts because it's my show. Anyway, we had there's some strong resistance coming in gold at the 1250 per ounce level. That's the 382 of the high we made way back in October. And it's also the 786 of the high we made in December. We did hit 1248 and change today, but the market broke. We had 1247.70 to be exact, and then the market broke down to 1212 that we discussed earlier, and that was a really surprising move to me. The market could move that quickly on such a small amount of contracts. There was only 11,000 contracts that made that happen, and there were none of them over a 60 lot, so that's really quite amazing in my opinion. But this is what I'm seeing in gold. I think we've got a chance to take the gold higher, but we'll have to wait and see. We've been following Barrick Gold, and I wanted to bring that up because we've reached a really nice Gartley pattern in Barrick Gold today. We're right at the 61% retracement. If you'll give me a second here, I will bring it up, and you'll be able to see that we've made the first objective of this ABCD pattern that we had down at 15 and change, and now we've gone up and we've hit the 1850 level, which was the 61% retracement coming off of the October high. So this is a normal place where we start to get a correction in the gold stock and in the gold and possibly the silver also. So this is what we'll be focusing on over the next few days, is to see where Barrick comes down to. We'd like to see it come down about 10% down to around the 1635 level, which would be a 61% retracement, and that would give us a really good chance, to come in and get a low risk trade on from the long side again, because the first profit objective has been made in this particular stock. So you'd certainly want to be taking your profits and getting ready to rebuy it when it backs off. You always take the risk of maybe it never backs off and goes straight up like Apple and Google, but we're not necessarily in that type of a market right now. So that's that's something that you want to keep under your hat to make sure you're looking at what you're looking at. We're still having a great deal of weakness in the stocks. We're down in the Dow Jones. We're down 53. We're near the low of the day. NASDAQ is still a little above the low that it made, and the S&P is also a little above the low that it made, but they're all still selling pressure coming in. Remember that on this rally up, folks, we had a declining advanced decline line. Even though the market in the Dow Jones and the NASDAQ and the S&P were going up, the advanced decline line was turning down. In other words, there were more declining issues than there were advancing issues, and that's usually not the case in a bull market. So that could have been the end of it. Maybe it makes another high. We'll wait and see. I don't think that it will, but what I think and what the market does sometimes are diametrically opposed. That's for absolutely the case. Someone asked a question about Google, and all I was saying is that Google has a potential to leave an island reversal up here. What you'd want to do is you'd want to see Google close around the 1105 level, and then if it gaps down on the next day, that's it, because all you have to do is you'd have to put your stop. If it goes back and fills that gap, something's wrong with the pattern. So you're trading an $1,100 stock, and you wouldn't have to risk very much at all. The problem is it's really hard to short that stock because you can hardly get shares of Google to short. I know it's pretty heavily traded, but a lot of firms don't allow it to be shorted. They just don't have the excess shares to be shorted, so you'd have to do an option. And I don't want to get into that bailiwick, because those premiums, they get a little bit dicey on both the long and the short side of the market. So just keep an eye on it. The reason why I'm watching it is because it's the largest, it's the highest price stock in the NASDAQ, and it's been the most bullish. So if the most bullish stock gives up and the NASDAQ is already starting to fail, you could imagine what would happen to the NASDAQ if some of the leaders start to roll over. And if that happens, and then you'd see some really significant moves coming to the downside. I've had a request from one of our listeners to take a look at that longer term chart that I've always focused on, which is the New York Stock Exchange Index chart on the weekly basis, and I'll put that up into the room so that you can see all the patterns that have completed here, along with the double top that occurred, and we'll notice whether this is going to be the case or not. We made that high on December 31st, which was the new moon, and we got the full moon coming in on the 13th. Folks, the best advice I can give you is when Basil Chapman turns bearish, you better be bearish, because Basil really follows the market with a terrific compass. He's got a pulse on it like I've not seen before. And when Basil tells you that it's time to head to the exits, I think it's time to head to the exits. That's the bottom line of what I know. I think very highly of him. There's only about 3 or 4 technicians that I know that I listen to, and he's one of them. And Carl Swinland is another one who's very, very good, and Rick LaRusso is pretty good, but Basil's in a class by himself. I'm not trying to, well, I guess I am tooting his horn a little bit, but he deserves it. Anyway, this particular chart that we're looking at here on the New York Stock Exchange Index on the weekly, there are 6 major patterns that completed. We had the double top that we talked about earlier from 2007. And remember, this is 6,700 issues of the largest traded, highly capitalized stocks in the world. We have an ABCD pattern from 2009 to 2013. We have a butterfly pattern from 2011 to 2013. We have a butterfly pattern in 2013, and we have a 3-drive pattern, 2 of them, one from August to November of 2013 and another one from May to November of 2013. So we have 6 major patterns completing on a weekly basis at the time when the Bradley model says that we're getting ready to turn down. And whether that's going to be the case or not, we have to remain patient to see. But once we get below 16,200, I believe, in the Dow, that would certainly tell people that something is really a little different. But remember, Bernard Baruch said that the greatest scam in all of Wall Street was to inflate something to a high price, and you'll get people to buy it all the way down because they'll be doing value investing and averaging down. And averaging down a position is it is the single most critical error that you can make in trading, is adding to a losing position. Of all the things you can ever do, you can trade without a stop and still get hurt, but if you add to a losing position, you've done 2 things. One, your original analysis is already wrong, and the second thing is you're doubling your risk. And both of those things, especially the second thing of doubling your risk, is even more important than anything else. So keep that in mind, that that's what happened. It was this kind of market in 1974 that caught me with my little knickers down. It was in July of 74, and the market went straight down from July to the October crash of 1974, and I learned a very, very expensive but valuable lesson. And most of it was caused by adding to a losing position and not using a stop, both related to money management. And that's just the the nature of the beast that we have in these markets. But I will mention that I'll mention one more time, and you can hold me to it, but I believe we'll see 500 points down at least in the Dow Jones one day between now and March 31st. That's my guess, and we'll see if that's going to happen. Not many of us were around during the 1987 fiasco, so I don't want to relive one of those days, because that was the most scary day I've ever had in the market, and I was on the right side of the market. I was long bonds and short stock, and I was still scared to death because I was afraid that the brokerage firms were going to fail. I couldn't get the broker to answer the phone, and luckily the plunge protection team came in. Dow down 55, NASDAQ down 23.
Have you subscribed to the Gold Report yet? On Wednesday, August 14th and Thursday, August 15th, Tom O'Brien advised his Gold Report subscribers to close out 6 of their 9 open positions, all winning trades ranging from a 10.69% profit to an incredible 48% profit in just one equity. Tom O'Brien brings an incredible wealth of knowledge and experience to the gold market and the equities within the industry. That's almost 12 years since this powerful newsletter first began. And right now, you can get a 30-day free trial to the Gold Report by visiting TFNN.com. Make sure you're a subscriber as this volatile gold market makes its way back into positive territory after declining all the way from $1,900 to under $1,200 an ounce in only 2 years. Get your 30-day free trial today by visiting TFNN.com.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different futures contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now you can receive a 2-week free trial to Taz Signal Box. For all the details and to find out how the Signal Box works, visit the front page of TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
To see some lowering of rates here on a short-term basis, but how much it'll be, I'm not sure. It'll most probably be just a 2 or 3 point rally in the Treasury notes, taking it up to the 382 of the previous move. The long-term nature of this market is just incredibly bearish. If you'll remember, when this thing was making a high, when the bonds were up around that 155 level, about 18 months ago, the whole world was bullish, and it turned out to be wrong. That was just a butterfly pattern of major proportions, much like we're seeing in the New York Stock Exchange Index here. But the same thing has occurred in the bonds, and they are going. We're looking at higher rates no matter what. But right now we're just tremendously oversold, and we need to have a rally up around somewhere around 125 to 126. Which would be about a third to a quarter point difference in rates from where we are now. We got to just about 3% in the 10-year note, and that was quite a bit. When you stop and think that they're only paying a 0.25% on your passbook savings, and they're making 3% from the feds, it's not a very fair deal. So just keep that in mind when you go to put your passbook savings in. It's better to own a note than it is to own a passbook, to let the banks, use your money. I still am at awe of the fact that J.P. Morgan was able to withstand all of those fines, $19 billion, and still, be making new highs, and doesn't seem to be affected by anything. But my goodness, I think if that would have happened to me, I would probably be strung out and quartered. It would be my guess, but that's not the way Wall Street works these days. So we'll just have to, see what happens in the long run of things. We have a situation here where Janet Yellen is going to be the new Fed chairman. The first time we've had a lady chairman. We're 100 years old now in this particular Fed. This is the third Federal Reserve Bank that we've had in our country. The first one was in the 1700s. The next one was 1835, up to 1835. And then we didn't have a Fed between 1835, I believe, and it was 1865 to 1913, I believe. I don't remember the exact years, but I know 1913 was when the newest Fed came in. And that's when they call it the Federal Reserve Board. Federal Reserve Board. They used to call it the U.S. Bank. It was the first U.S. bank, and then I think it was the second U.S. bank, and then the last one was the Federal Reserve, which is a private corporation. You have to realize that. They control our money. Just look at your bills in your pocket, and it said Federal Reserve Note. It does not say United States Treasury. It says Federal Reserve Note. So we'll see what's going to happen through how they get through this QE thing, and they'll probably add more money and inflate prices some more. But we'll have to see what happens. The problem is if they've made a mistake and they can't get out of it, and no one knows because this is a big experiment. That could be the bubble of bubbles if that does occur, and that would be something that would really be detrimental to all of us. Yeah, that's my opinion. Live every day in an attitude of gratitude, and may God bless, my friend.
We're told to follow